S&P expects the UAE's economic growth to slow this year due to OPEC's oil production cuts, deceleration in the non-oil sector, and higher interest rates. For details, I'm joined by Mohamed Damak, Senior Director at S&P. Thanks so much for joining us today. Now, S&P expects the UAE economy to grow more slowly this year on OPEC production cuts and high interest rates. What's your forecast for UAE economic growth?
Thank you for having me. We think that the UAE economy will slow down this year to around 2% compared with 6.5% in 2022. And the slowdown will impact both the oil sector because of the OPEC agreed cuts and the non-oil sector as it grew strongly last year. So there's a base effect. And as we project the lower performance on some sectors this year, including trade, the retail sector, and less so the tourism and hospitality, mainly supported by the expected return of the Chinese after the market has reopened.
It's a huge difference, 4% roughly. And the UAE's interest rate hikes have mirrored those of the U.S. despite much lower inflation numbers here. Do you expect the UAE to continue to raise its rates in line with the U.S.? We're going to hear about the next rate hike just this week.
The UAE dirham is pegged to the US dollar, and this arrangement has been in place for a very long time. I think the peg historically has helped to anchor inflation expectation and also the predictability of the UAE monetary arrangement, especially when during episodes of oil price volatility. And as such, and given the fact that we expect the peg to remain in place, we think that the central bank of the UAE will continue to follow the Fed movement.
Other Gulf currencies are also pegged to the US dollar, and they're not necessarily raising rates exactly in line with the US interest rates. Why are we still raising rates here when our inflation is much lower than that of the US?
I think most of the central banks where the currency in the GCC, where the currency is pegged to the US dollars, are following the Fed. Whenever the Fed raises the rate, the central banks in this region raise also the rate, and that's in order to preserve the peg and in order to avoid any issue or any possibility that the peg will no longer hold. And again, we expect the peg to continue and to be maintained in the future, and that's why we think that the UAE and also other central banks in the regions with currencies pegged to the dollar will continue to follow the Fed.
What impact do you think increasing interest rates here will have on lending? Will people and will companies borrow less in 2023?
We expect lending growth to be positive in 2023, although we expect a slowdown compared with 2022. And that's because, one, interest rates or higher interest rates will make it more expensive for corporate and individuals to borrow. And secondly, the expected slowdown in the economy and the uncertain global conditions could push corporate to adopt a more cautious approach to capital spending.
And in terms of UAE real estate, you forecast prices will moderate in 2023 after a record 2022. Is this because mortgages are too expensive now?
I think the year 2022 saw strong demand for residential real estate, demonstrated by price and rental increases. And towards the end of 2022, we saw the re-emergence of payment plan from the developers, which support the attractiveness of planned sales, especially given the increase in interest rate. Now, we expect 2023 to be a good year for the real estate sector, but we anticipate that property demand, price, and rental increase will moderate compared with what we observed in 2022. Oversupply is still a concern, but a long-term concern in Dubai because of the significant growth of planned sales as more property will be delivered in the coming years. And finally, mortgage contribution to the demand is fairly limited. It's around 1/5 of the overall transaction. And it's clear that with the higher interest rate, mortgage growth is likely to slow.
Okay, Mohamed Damak, Senior Director at S&P. Thanks so much for joining us today.
Thank you very much for having me.